Hey everybody, welcome to another episode of Stock Talk. My name is Reca. I'm an investment coach, investors, and this is episode 57, and it's also our last episode for 2016. Today I just basically wanted to review some of my personal investment activities and observations for the year, and some lessons and some takeaways that came out of this year, because it was an interesting year, and that's we faced three really kind of flashpoints in the investing environment and the investing community, and how you reacted to those situations, how you dealt with those situations, really goes a long way in terms of how your success for the year. So I'm going to talk a little bit about that. But first, I want to talk a little bit, I guess, on a personal note. As I said, this is like my last episode for the year, and it's amazing that 12 months ago, 56 episodes ago, I started doing this. I started popping up Periscope and started talking for 5-10 minutes every week about investing topics and things that I'm facing and decisions that I'm personally facing. And I'm amazed that I'm actually still doing this. And even though I don't think I get that many people listening to me right now in real time, the cool thing about Periscope is that you can archive stuff, and that's usually where I get more people telling me, reaching out to me and interested in what I'm doing and interested in my practice and my coaching practice, investment coaching practice. And so it's just something I feel really proud of, the fact that I've actually been able to stick with this for the whole year, and I'm hoping to keep it up into 2017. So it's one of those accomplishments right now that I'm trying to feel pretty good about. The second thing I'm also pretty proud of in terms of what I've been able to accomplish for my investing practice is to develop these courses that I've developed. Traditionally I teach people face-to-face or on Skype or whatever how to invest, but now I've developed all these courses that you can stream online. My everyday investing courses and my courses on how to invest in ETFs. At the start of the year, it was kind of a dream. I didn't think I was going to do it, but now, guess what? If you go on my website, it's online. And to me, that's a personal life. Really feel quite satisfied and quite accomplished. So for me, 2016 was really a positive year in terms of some milestones that I had set out for myself. And usually, resolutions are hard to meet, but I'm really proud of what I've done. So that's just done on a personal note. So let's talk about the year that just went back. As I said, there was really three flashpoints. When I look back at the year and how I went through this year and how we've gone through this year from an investing perspective, there were really three flashpoints that really determined how we're going to do, how our investments were going to do. So the first flashpoint was literally 12 months ago. If we can even remember that far back, you remember the Chinese stock market was just in a meltdown mode. It was just crashing royally. We had oil prices that were just tanking. And if you remember, January was a brutal month for the markets. As much as we got all the stuff going on right now, everybody's all happy. 12 months ago, it was pretty pissy back then. And so how did people deal with that? If you let emotions get in the way, you would have probably been selling and running away with it, because that's what the experts were telling. I remember that UBS put out a research note saying sell everything, just get out of stocks in January. So if you had followed that advice, looking at where we are now, wouldn't have been a great move. And so for me, in January, I look back at what I did in January. Instead of just sitting around and being scared about the market, I took a more offensive approach, and I was buying stocks. Quite aggressively. I was buying stocks like Las Vegas Sands, Cisco, Southern Copper. Copper prices were depressed back then, and I was buying copper stocks. Nordstrom, Williams-Sonoma, Tiffany, luxury retail back in January was in the doldrums. It was tanking. And wonderful, well-run companies back then were selling at a discount, so I was buying them. And now looking at them, 12 months later, I sold Las Vegas Sands. I made 8%. Southern Copper made 30%, thanks to Trump, really. We'll get to Trump in a second. Nordstrom's made 22% return. Williams-Sonoma was 9%. Tiffany, 23%. Imperial Oil, I was buying oil stocks as oil was tanking back then. I was buying companies like Imperial Oil, and I sold that. And right now, I still own it, and I'm up 10% on it. And so that, it's just that mindset. And I'm going to get to it in terms of the takeaways of that. So that was one flashpoint in 2016. The second flashpoint happened literally 6 months later, the Brexit vote. If we all remember, every analyst, pundit out there was pounding the table saying, it's not going to happen, people will vote it out, and England's not going anywhere. Guess what? They voted it out. and the market crapped out in June, if we remember that far back. And again, same mentality. If you went along and let your emotions take control of that situation, you would have sold everything. And as we know, after 2 or 3 days, the market just kept on going right up. At that time, I look back in my notes, and I was buying more shares of Nordstrom at the time. I was buying more shares of Tiffany. I was buying more shares of Williams Sonoma. I was buying more shares of an ETF, of an India ETF, and those stocks continued to rise right after it because I used it as a buying opportunity. So that was another flashpoint. And then the latest flashpoint of obviously in November is the whole Trump thing. Again, every pundit, every analyst, every expert out there pounding the table saying there's no way in hell this dude, this idiot, quote unquote, could win this thing. And guess what? He won. And the markets hated it at first, and this time is a little different because the markets hated it for about 3 hours overnight on November 8th, but since then, market's up almost like 9%. Everybody's happy. All the economists and all the analysts at the time who were all saying if Trump won, it's going to be like, a disaster. And hey, now all of a sudden they flip-flopped and the markets are up. So during that period of time, again, I could have taken a reactive approach and let the emotions drive the situation, but instead, again, I went out and bought shares. I bought shares of Google, I bought shares of New Line, shares of Tyson Foods. And at that time, because of the second wave, then we had a whole wave, all the stocks that I bought earlier in January, they all popped, and I sold them in December, November, December, for pretty healthy gains. So those were really three, when I look at 2016, those were really three kind of flashpoints. So what are the lessons? What can we take away from some of this stuff? How can we take away some of what we've seen in 2016 and apply them going forward? Well, the first thing is, don't panic. When you get into these periods, and these were periods of really hysteria, a lot of emotion was kind of getting into the fray of things. The worst thing you can do as an investor is let those emotions kind of influence your investment decisions. And I know it's freaking hard. It's really hard when you see stuff on TV, you see stuff on Twitter, you see analysts pointing, big bold letters, sell everything, get the hell out of stocks. It's really hard. But the worst thing you can do is panic in these type of situations. And the best thing you can do in these type of situations is do nothing. And that's what really, unfortunately, all of us, we're all wired. We have wired to react to things. We're all wired to react to negative or shocks that occur around us. And it's tough. So one takeaway, if you had just done nothing, if you had investments at the start of the year and you just did nothing throughout the year, all these things happen and you just said, you know what, I'm just gonna stay passive about it and just ride what I have because I like the investments that I have, you probably had a really good year. But if you let emotions have driven you in each of these three events, you probably are not going to have as great a year. So emotions, you got to keep them in check. And that's really what I do as an investment coach, is I help people manage their emotions. You can't eliminate emotions, you can't be a robot, but you can manage them and control them. And that's the beauty of working with an investment coach, because I'm focused more on the behaviors as well as the mechanics of figuring out what stocks you want to buy and sell. Second theme is the importance of having an investment plan, or more specifically an ideology of what you're going to use, the methodology and ideology and criteria you're going to use to identify great companies, identify companies you want to invest in, and identify companies you want to sell. It's having that ideology. If you have that ideology built in to your decision making, and that framework is your decision making, you're going to make better investment decisions. So despite all these things that went on, and again, I point to my personal case, in January, when everything was crapping out, I was buying stocks because my investment ideology revolves around quality, buying well-run, well-managed businesses that are selling at a discount. And at that time, stocks were getting thrown out like the baby gets thrown out with the bathwater. And those are the ultimate times where, as an investor, you need to just not start figuring out what stocks you want to buy. You should already have a plan. You should already have your list of companies you want to buy, and it's just execute. So having an ideology and a plan, an investment ideology, is important. And if you don't have one right now, you need to start getting one. And work with an advisor, work with an investment coach, get that. Because during these flashpoints, it's going to help you stay disciplined, it's going to help you stay true to your plan, and it's going to increase your probabilities of success. So staying true to an ideology is critical. Third takeaway that comes out of this year is just all about consensus. And having that resistance to following the consensus. As I say, a lot of decisions you make are emotions. Emotions screw up our investment decision-making process. And one way we get screwed up on it is we want to follow what the it people are, what the smart people are saying. If you had followed, the issues that were happening in January with the China market, if you had followed what all the analysts were talking about and getting out of stocks, you missed a huge opportunity. In the Brexit thing, every analyst was pounding the table that there's no way that the vote was going to happen, and people were making investment decisions based on it. They got caught. And then the whole Trump thing, we've been down there. Nobody saw this coming. So it's important to identify consensus, but it's really important that you kind of have to avoid the consensus and challenge the consensus. So if the consensus is saying, if all the smart people and the analysts are saying buy stocks, you got to scratch your head and say, you know what, maybe I might want to take the other side of the trade. Because as an individual investor, that's one of the best weapons you have to being successful. You've got to challenge that consensus level of thinking. So that's a huge thing. And we saw that quite evident in 2016. And we're going to see it again in the future. So having that awareness of what a whole group of the market psychology, of the sentiment out there, of individual investors, of the expert consensus is an also important takeaway to have. So to me, those are three of the big takeaways. And these are takeaways that really just didn't happen in 2000. They happen all the time, but they really got nicely crystallized at really key moments throughout the year. And how you dealt with those moments really, I think, goes along with how effectively you're going to be how effectively your returns were going to be for the year. So the key thing is taking these elements and taking this awareness and taking these into 2017 and starting to apply some of these things. And if you're not hesitant, a lot of people are hesitant about it, they're scared about it, that's really why you need to work with an investment coach to me instead of an advisor, because an investment coach is going to manage, help you learn and come to better grips with your behaviors. And it's not going to be worried about what's in your bank account and what can I sell you. Investment coach, that's what I don't do. I don't sell like mutual funds or insurance or all that stuff. I tell people intelligence so they can make their own. I tell people independence so they can make better decisions on their own and not be dependent upon other institutions. So for me, 2016, I haven't crunched the numbers yet in terms of my portfolios and my returns. I'm probably going to post a blog in January with my final numbers and everything. You can take a look at it. I have a feeling that my numbers aren't going to be, as a snapshot in terms of returns, aren't probably going to be that great. But I know, looking at the decisions that I made this year, I made a lot of good decisions that panned out, and a lot of it was to these elements of not following the consensus, buying low and selling high, and sticking to an ideology. Critical elements. So I hope, to me it was a good year, but you know what, 2017 is coming up, it's another year. The market has a nice way, to really, if you get confident, to really smack you in the face and tell you to shut up, because it's hard to do. It's hard to do consistently over a long period of time, and so we'll see what happens. So, I hope you all had a really good year. I hope you all made some really good investment decisions, and as long as you're sticking to your ideology and sticking to your plan, you're probably going to make good investment decisions in 2017. So that's all I got for you today. I'm going to be taking a couple of weeks off to enjoy the holidays. I'm going to hang out with the kids, hang out with the family, play in the snow, do all that fun stuff. So I just want to wish you all a very Merry Christmas and a Happy New Year, Happy 2017, and we'll catch you on the other side of the calendar and with more wonderful episodes of Stock Talk. And if you have any questions, you want to hit me with something, shout out through my Twitter handle @SageInvestors. I'm on there tweeting about anything and everything about stock markets. Or you can hit me through my website, www.sageinvestors.ca. Hit me through an email. If you want to learn more about my online courses, you can go to my website too. And give you more information, and you can register and you can start learning about investing. Hey, it's 2017. What a wonderful way to start the year off by upping your education game with learning how to invest. And I can help you out with that. So have a great holiday season. We'll catch you again in 2017, and all the best. Take care. Bye.